Welcome to the Bullvine Podcast, your go-to source for inside stories, cutting-edge research, and the latest updates in the world of dairy farming. In our 152nd episode, we take a look at the global dairy markets from the past week. So please grab a glass of milk, sit back, and let's get started with this episode.
Welcome to the Bullvine Podcast, where we bring you the latest insights shaping the world of dairy farming. I'm Douglas, and joining me is Belle. Today, we're diving deep into a topic that's causing significant upheaval in the industry: new tariffs, shifting global markets, and what it all means for dairy farmers. Belle, why don't you set the stage for us with an overview of the current situation?
Thanks, Douglas. The recent implementation of 25% tariffs on North American dairy trade has sent shockwaves through the industry, affecting a staggering $1.2 billion in trade between the U.S. and Canada. This situation is creating real challenges for farmers and processors alike. We're witnessing a stark divide in regional dairy prices. Some markets are thriving, while others are struggling. For instance, demand from Asia has surged, leading to increased prices for products like whole milk powder, which jumped 2.5% to $4,012 per ton in recent trades. Similarly, skim milk powder prices in Asia have risen 0.2% to $2,976 per ton. In contrast, European markets are facing significant pressure with oversupply issues that have caused prices for products like butter to decline. European butter futures plunged 2.3% to €7,109 per ton last week, highlighting the challenges faced by producers in that region. This divergence is creating both opportunities and challenges for dairy producers around the globe. It's important to note that these price shifts are occurring against a backdrop of changing production patterns. In the United States, for example, milk production dropped 0.5% in December, despite component levels jumping by 1.6%. This suggests that farmers are focusing more on fat and protein content rather than overall volume.
Those are some striking figures, Belle. It's clear that these changes are impacting farmers in different ways. Can you elaborate on how these regional price shifts are affecting market dynamics in various parts of the world?
Absolutely, Douglas. In Europe, we see that while some product prices have risen slightly due to seasonal factors, there is still a lot of pressure on farmers as they deal with high production levels. For instance, EU butter prices increased by 0.5% to €7,471 per ton, and skim milk powder rose 0.4% to €2,517. However, these modest gains are overshadowed by the overall increase in supply, which has led to lower margins for many producers who are struggling to find buyers for their products. Conversely, Asian markets are experiencing a boom in demand. Buyers are actively seeking high-quality dairy products, which has resulted in higher prices for whole milk powder and other value-added products. This demand is driven by changing consumer preferences in Asia, where there's a growing appetite for dairy as part of a balanced diet. The 2.5% increase in WMP prices to $4,012 per ton is a clear indicator of this trend. In Oceania, we're seeing mixed results. New Zealand has seen a 1% increase in milk collections, with the North Island showing a particularly strong performance with a 1.9% increase. However, Australian farmers are facing challenges with a 1.1% decline in production, although their season-to-date numbers remain positive at 0.8% growth.
It sounds like the Asian market presents a significant opportunity for exporters who can meet that demand. But what about here in North America? It seems like the tariffs are complicating things even further.
Yes, indeed. The tariffs have created immediate challenges for U.S.-Canadian trade relationships. U.S. butter exports to Canada, a market worth $119 million, are under immense pressure due to these new trade barriers. This market was previously a reliable outlet for U.S. producers, but now they face increased costs and uncertainty. On the Canadian side, there's an oversupply of 83,800 tons of cheese that needs new markets. Farmers there must quickly adapt to find alternative buyers or risk facing losses as inventory builds up. This situation affects not just farmers, but also processors and distributors who rely on smooth trade flows. It's worth noting that government relief packages only cover less than 20% of the projected losses incurred by the industry. This leaves many producers in a precarious financial position as they try to navigate these new market realities.
Those are significant challenges indeed, and it's not just the tariffs creating issues. Feed costs and input prices play a crucial role as well. Can you break down the current situation regarding these factors?
Absolutely, Douglas. Feed costs remain one of the largest expenses for dairy farmers, and any fluctuations can greatly impact profitability. Currently, corn futures for March 2025 are at $4.90 per bushel, and soybean meal is at $304.70 per ton. The dairy margin coverage feed price remains unchanged at $9.92 per hundredweight. While these prices have been relatively stable recently, there's always an underlying risk of volatility due to factors such as weather patterns or geopolitical events affecting global supply chains. For instance, concerns about South American weather conditions could potentially impact feed prices in the coming months. Farmers need to be proactive in managing their feed contracts and exploring options to lock in favorable pricing when possible. As input costs rise, whether from feed or other operational expenses, producers must carefully consider their budgeting strategies to maintain profitability.
Thank you for that detailed breakdown, Belle. Another critical issue that's been on many farmers' minds is the declining heifer numbers in the U.S. Can you elaborate on this trend and its potential long-term effects on milk supply?
Certainly, Douglas. The decline in heifer numbers is a significant concern because it suggests potential supply constraints down the road. U.S. dairy heifer numbers have hit their lowest point since 1978, which is nearly a 50-year low. This trend could lead to tight milk supplies in the future, especially if demand continues to grow in regions like Asia. With fewer young animals entering herds each year, we could face tighter milk supplies just when demand may be increasing. This situation could potentially support higher prices for dairy products in the long run, but it also creates challenges in terms of meeting growing global demand. Farmers need to rethink their herd management strategies in light of this trend. Retaining more heifers rather than selling them off early could be a wise move to ensure future supply stability. However, this decision needs to be balanced against the immediate financial needs of the farm.
Those are excellent points, Belle. Given all these factors, tariffs, regional price disparities, feed costs, and declining heifer numbers, what strategies should dairy farmers consider to navigate these turbulent times?
There are several key strategies that farmers can implement to adapt to this challenging environment. 1. Flexibility in production and marketing. Farmers should be prepared to adjust their production focus based on market demands. For instance, the shift towards higher component milk in the U.S. shows how producers are adapting to market signals. 2. Diversification of export markets. With the disruption in U.S.-Canada trade due to tariffs, farmers and processors should explore alternative markets. The growing demand in Asia presents opportunities for those who can access these markets. 3. Cost management. Keeping a close eye on feed and input costs is crucial. Farmers should consider locking in favorable prices when possible and exploring alternative feed options. 4. Long-term herd management. Given the low heifer numbers, farmers might consider retaining more heifers or investing in genetics to improve herd productivity. This could help ensure a stable supply in the face of potential future shortages. 5. Investment in efficiency and technology. Adopting new technologies that improve operational efficiency can help offset rising costs and improve competitiveness. This could include advanced monitoring systems for herd health or new processing technologies for creating high-value dairy ingredients. 6. Sustainability focus. As consumers increasingly prioritize environmentally friendly products, farmers should consider implementing and showcasing sustainable practices. This could provide a competitive edge in certain markets. 7. Stay informed on market trends. Regularly monitoring global dairy market trends, trade policies, and consumer preferences can help farmers make more informed decisions about production and marketing strategies.
Those are comprehensive strategies, Belle. As we look ahead into 2025 and beyond, what trends do you foresee continuing or emerging in the dairy industry?
Looking forward, I believe we'll continue seeing regional price divergence driven by various factors, such as trade policies and shifting consumer preferences. The stark contrast between Asian markets and European markets is likely to persist. We can expect the growing importance of Asian markets to shape global dairy trade. As Asian demand continues to rise, North American and Oceanian producers will need to adapt their strategies to compete in these markets, potentially leading to changes in product mix and export patterns. Sustainability will become an increasingly critical factor. Consumers are becoming more environmentally conscious, and this trend is likely to accelerate. Farmers who can demonstrate sustainable practices may find themselves at a competitive advantage. The impact of climate change on dairy production will likely become more pronounced. We may see shifts in optimal dairy production regions, changes in feed crop availability, and increased emphasis on heat-tolerant breeds. Technological advancements will play a pivotal role in how dairy farms operate moving forward. Precision agriculture, robotics, and data analytics could help farmers improve efficiency and reduce costs. For instance, advanced monitoring systems could help manage herd health more effectively, potentially offsetting some of the challenges posed by declining heifer numbers. We may also see increased consolidation in the industry as smaller farms struggle to adapt to these changing market conditions. The ability to achieve economies of scale and invest in new technologies could drive this trend. Lastly, the ongoing volatility in feed markets will continue to be a significant factor. Managing these input costs will remain a critical challenge for dairy farmers.
Thank you for that comprehensive outlook, Belle. It sounds like while there are certainly challenges ahead, there are also opportunities for innovative producers who can adapt quickly to changing dynamics. Any final thoughts for our listeners?
Absolutely, Douglas. The current landscape presents both obstacles and chances for growth. By staying informed and being willing to pivot their strategies based on market signals, dairy farmers can position themselves favorably even during uncertain times. It's crucial to remember that while the 25% tariffs on $1.2 billion of U.S.-Canada dairy trade have created immediate disruptions, they also underscore the need for diversification and flexibility in export strategies. The contrasting trends we see highlight the importance of understanding and adapting to regional market dynamics. Moreover, the decline in U.S. heifer numbers to a 50-year low serves as a wake-up call for long-term planning and herd management. This trend, combined with the slight shift we're seeing towards higher component milk production, suggests that quality and efficiency will be key drivers of success going forward. As we wrap up this discussion today, I want our listeners to remember that navigating these complexities requires diligence, adaptability, and a willingness to embrace new technologies and practices. Whether it's adjusting production methods, exploring new markets, or investing in sustainability initiatives, proactive measures will be key to success in the evolving dairy landscape.
Well said, Belle. And thank you all for tuning in to this extended episode of the Bullvine Podcast. We hope this in-depth discussion has provided valuable insights into navigating today's challenging dairy landscape. Remember, staying informed about market trends, from regional price disparities to feed cost fluctuations, is crucial in making sound decisions for your operations. We encourage all our listeners to take a proactive approach in managing their dairy farms. Consider how you might adapt your strategies in light of the information we've discussed today. Whether that's reevaluating your export markets, adjusting your herd management practices, or exploring new technologies to improve efficiency. And as always, we at the Bullvine are committed to bringing you the most up-to-date and relevant information to help you navigate these challenging times in the dairy industry. We'll be closely monitoring the situation and bringing you regular updates on market trends, policy changes, and industry innovations. Until next time, this is Douglas.
And Belle, wishing you all continued success in your dairy farming endeavors. Remember, in times of change, there are always opportunities for those who are prepared and willing to adapt. Stay resilient, stay innovative, and stay informed. Goodbye for now.
Thank you for tuning in to the Bovine Podcast. We hope you enjoyed today's insightful discussion. Don't forget to subscribe, share, and leave a review. Catch you next time on the Bovine Podcast, where bovine expertise and community come together.